Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Hello, this is Paul Harris for Kitco at the 32nd BMO Global Metal Mining and Critical Minerals Conference in Florida. A great pleasure to be joined this morning by Colin Hamilton, who is Managing Director of Commodities Research at BMO Capital Markets. Good morning, Colin.
Good morning, Paul.
What a great event. I always enjoy this opportunity to sit down with you and plug your brain for insights into what's happening in the metals space. This year has its largest ever attendant and the largest amount of investors. The company has also extended the scope to include critical metals formally for the first time. Why the adjustment of scope, and are you seeing more generalist investors starting to become interested in the metal space?
I really think so. In terms of the generalist investors, there's now a crystallization of the fact that we probably have underinvested in the extractive industries over the past little while, and there is some good returns to be made, and we're going to need to do more in that area. So the importance of metals, the fuel to materials transition is really coming to the core. Now, in terms of the change of the name of conference, well, critical minerals are really coming to the forefront of attention. They're right at the pinnacle of geopolitical risk. And we're seeing a lot more of that come through in markets, and we're seeing a lot more reshoring of value chains. And with that, critical minerals are important not just to investor standpoints, but strategic investors as well, like the OEMs and even like the government. So this is why we've broadened the scope, and I think it's worked extremely well.
And the bank's also taking a leading position in sort of carbon credits, ESG, emissions, that kind of thing, the Sustainability Institute part of the bank. So you're really sort of trying to lift the bar and set the tone.
Well, BMO, we like to say we boldly grow the good. That is our phrase. And part of that, I mean, the metals industry is one which it struggles, and we heard from the ICMM, they struggle for trust in the metals industry. Part of the role we have at BMO is to support the metals and mining and critical mineral sector in order to get the right waypoints checked off and do it in the right way. So with that, the ESG side, the Climate Institute side, it's all part of the offering that we offer to both investors and corporates alike.
Okay, I've got to talk about M&A. By my reckoning, there's at least 6 transactions on the table at the moment, and 3 have been announced during the event itself. Let's start, it's going to be a 3-part question, looking at different metals. Let's start off with the battery metals. There seems to be a jockeying for position in battery metals such as lithium, cobalt, nickel, with battery companies and automotive companies getting into the fray in addition to the bigger mining companies. What's driving this?
Well, it's interesting. The bigger mining companies, of course, these metals are small for them, and they've never really quite got themselves fully into it, but they're now having to play catch up. And the OEMs are, of course, worried that the supply is not going to be there, and they need that security of supply. They're coming out with big targets and having to backfill that with raw materials. And it's not something they've been used to over the past 20 years. They wanted something, it was there. Now they're having to make sure it's there, and that's part of the change. And in these real fast growth areas, well, we do need a lot more projects, and to advance those projects, M&A is going to be crucial to that, to really form the next stage of emerging leaders in the industry.
I mean, it's odd because within the metals space and mineral space, this has been a setup that's been obvious for a number of years. It seems it's only relatively recently that the pennies dropped with the OEMs and the battery companies that, hey, we may not have the minerals that our products need.
Well, we've had 30 years of globalization, and with that, you and I as consumers, well, we wanted something that was there. We went down the shop, we expected stuff to be there. If you were a utility, you expected fuel to be there. If you're a manufacturer, you expected metals to be there. With the lack of investment, that's no longer the case. It's taken a while because with the nature of mining, well, if you invest, it takes a little while to actually come, and we still have supply coming through from previous investments. What everyone can see now is the future pipeline is looking very thin, and that's what's got many more of these end users a little bit more concerned.
Well, let's talk about copper M&A now. Let me bring in copper because the copper pipeline in particular is very thin, and I would argue copper is the most critical metal of all, even though not every government recognises it as such. There have been a few big M&A transactions, but by and large I think they've been noticeable by their absence. Why are we not seeing more copper transactions, given that there's a supply deficit coming, there's a thin pipeline of new projects? What's going on there?
Yeah, it's very interesting because the polling we've been doing during the conference, we've had our polling on our app, 75% of people polled says the metal they'd like to hold on a 5-year view is copper. So it's ubiquitous that everyone wants more copper. but no one's really pushing for it. And I think it's partly because, I'd say, there are very few assets around, so the bidding can get quite competitive, but also long-run prices probably haven't gone up enough. So I now use substitution pricing for copper in the longer term because I can't incentivize enough assets to solve the problem. So I think if people start ratcheting up away from incentive pricing to substitution pricing, actually that's when we might see a re-rating of the sector, and that's when we might see more transactions come through.
Okay, in terms of substitution pricing, how much per pound are we looking at?
Well, I look at 3.5 times the aluminum price. So that is what I use as a through-cycle norm. So the price of aluminum therefore becomes very important to the price of copper. And we take this forward, the price of carbon will become very important to the price of aluminum because it's a very thermal coal dominated industry. So if suddenly the aluminum price goes up because we're factoring in higher global carbon pricing, well, the substitution price for copper goes up even more. We could be looking in the longer term at $4 to $5 copper being the norm.
Okay, I guess there's another factor as well. Building a copper project becomes increasingly expensive. Perhaps in the last cycle, $1, $2, $3 billion. Teck, I think, announced that its QB2 expansion cost is $7.5 billion. Going forward, I think most people expect a decent-sized copper project to be the $5 to $10 billion range. I imagine it's very difficult for a CEO or a board to recommend deploying that amount of capital.
I think that's exactly it, Paul. And it's not even just the capital itself. Balance sheets have been cleaned up a lot across the sector. It's the time frame. It's what you know and what you don't know. You know environmental permitting is a lot harder than it has been before. It's going to take you 3 years longer to get payback potentially in that project. You know we're in an inflationary environment, so you know capital costs are going up, so you're less sure of the economics of your project. And thus far, the one thing you do know is that your shareholders probably don't want you to strain the balance sheet. So therefore, it's much easier to just say, no, we'll look at it in the next board meeting. We're starting to see a little change. We're starting to see, I think, a pushback towards the 80s and 90s when we saw projects come up that were joint ventures at the asset level between 3 or 4 companies. And you could argue the mining industry got greedy. Everyone wanted to do it just themselves. Actually, we have to spread that risk in order to get these greenfields going. So I think we're moving back more towards that model.
That's fascinating. I want to end the M&A section of our conversation talking about gold. As I mentioned, there's 6 transactions on the table at the moment. The conditions and outlook for gold haven't really changed over the last 6 to 12 or even 18 months. So why do you think these transactions are happening now? And how far do you think this consolidation moment will go?
Yeah, I won't comment on any individual transactions, of course, but what I do think, and there's a couple of interesting things around some of the larger transactions. There's clearly a copper element to those as well in many cases, and I think that's becoming increasingly important. You are seeing the gold industry talk up more these other metals that they produce, and copper is a core one of those. I also think, there's a lot more pressures from ESG side, from various other areas that are harder for a smaller company to manage on their own. So we're naturally starting to see a bit more consolidation in the sector to almost cope with that. And when there can be synergies achieved, then that's obviously all for the better.
I think another interesting aspect there, we're starting to see the ESG aspects become more prominent in the economic studies. Companies reporting what their CO2 equivalent per ton of copper produced or per ounce of gold produced will be. And we're starting to see as well these sort of metrics becoming part of financing agreements. I know you don't really want to talk about any specific companies, but Anglo American made an investment earlier this year, and within that, they wanted the carbon credit associated with the production they were looking to get their hands on. And I expect that's going to be a bigger trend going forward.
I think so. The way I look at it, I think we move towards not just green metals, but also responsibly sourced metals. So I think we're seeing a big push, and we're seeing the industry push towards standards that will say, look, if you want this copper, this gold, whatever it may be, we can prove that it's come from the right place and it's socially responsible, it's adding value to the community where it's mined, and it's in the bottom half of the carbon curve. So as a consumer, you want to do best practice sourcing, that's the metal you're going to want to see. And I think it therefore becomes a marketing tool in the medium term.
Excellent. Now, we're at an investor conference, so let's talk a little bit about capital markets. There seems to be a lot of money flowing again into copper exploration and into battery metals exploration, specifically lithium. There's been a number of new lithium companies and copper exploration companies launched in recent months. With capital going into the exploration of those metals, does that mean that there will be limited funds, limited equity available for gold exploration this year?
I think we are seeing a little bit of a shift away from the traditional precious metals exploration towards some of these other metals. for a couple of reasons. I mean, number one, just basically these metals are fast growth and they're green, and actually more people want to be involved in that area maybe than the past, and they see it as potentially the future of the industry. So I think that's been part of it. I do think, though, for both the precious metals industry and the wider industry, the productivity of spend and exploration can go up. We've actually seen a lot of new technologies come to market in the past 4 or 5 years. So even if we're spending a little bit less, we might be picking up the discovery rate a little bit more. And I do think the mining industry is very good explorers and engineers, and I think they will find a solution to this.
Okay, excellent. Now, gold producers, copper producers, the returns to shareholders has been a key theme in recent years. You mentioned balance sheets have been repaired and are in healthy conditions, and so return to shareholders has risen up the corporate agenda and doing very well. Are we at a stage now, are you happy to see this continue, or is there a risk that companies are perhaps giving away their balance sheet firepower, which may limit their strategic options going forward?
I think you can make the argument we've certainly moved a little bit too much towards shareholder distributions and at the expense of growth, no matter what the industry may be. Now, if we look at it, I think you're now starting to see the companies plead a little bit more to be allowed to do more growth again. If we think back to some of the projects that were done in the past, unfortunately they were not great from a capital return standpoint. The industry, I would say, is now starting to regain the trust of investors. And what's interesting, we're starting to see, we talked about the energy transition a lot. The mining industry is maybe getting a little worried it might be blamed for holding up the energy transition by not investing. So going back to shareholders and saying, look, please, we have a good project, please just let us do it a little bit more. So there will still be high capital return to shareholders. We have attracted a lot more generalist investor interest into this sector with the returns, but it just has to be balanced between the growth side as well.
I imagine there's going to be some very interesting conversations there, because investors obviously cover the whole panoply of viewpoints. Some really want growth, some are really perhaps getting used to or accustomed to getting 3, 4, 5% yields,
Yep.
and perhaps won't want to sacrifice that.
So it's an interesting one. What is the minimum yield level that will have to be to keep them in the industry? And then anything over and above that has to go towards growth. And of course, commodity prices themselves will play an important part in that. And then we are looking at markets which are looking still relatively tight in the main over the coming years.
Okay, well, let's go into the markets, the commodity markets a little bit more. What do you think, what does the bank think is the outlook for sort of gold, copper, lithium this year?
So let's take them in turn. I mean, gold is always an interesting one, always has slightly different dynamics, whether it be the dollar, whether it be real rates. What we're seeing in gold, of course, very strong central bank buying at the tail end of last year, very strong retail buying, which continues to this day. So some of those core elements of gold are still there. Struggling a little bit for macro asset allocators. They are looking at different factors at the moment. We're seeing very choppy ETF flows. This is a good gold price, $1,800 now. It's actually, by historical terms, a pretty reasonable gold price. We're of the view that consolidates at this sort of level for much of this year. Can't see any major reason for it to break out in the downside, particularly given the geopolitical backdrop that we're in. But it's hard to see where you get the macro asset allocators really interested again to push it above 2,000.
Okay, and for copper and lithium?
This is meant to be a bad year for copper. This is meant to be a year where we had too much supply. That's really no longer the case anymore. So we come into this year with very low inventories. I'm revising my demand actually slightly higher again. Europe's not as bad as I thought it might be in the first half of this year. And supply is causing us problems. We see a lot of unrest still in Peru, and therefore the disruption on the copper supply side is an issue. The copper price has had a good start to the year. It's pricing in, I would say, China perfection to a certain element. But we do think China will get better. So we're looking at a copper price doing well above the cost curve for much of this year. It's done a lot of the work, but it offered very high returns to the companies.
Are you forecasting that this year will be a copper surplus or copper deficit?
We're basically a balanced copper market, but it was expected to be a surplus until very late last year, I would say.
Okay, and
the lithium side, yes. I mean, lithium had a phenomenal year last year. I mean, we saw a record price by a long way, and it was a bona fide raw material constraint. There's definitely a soft patch coming through the market at the current time, in that China's central electric vehicle subsidy was removed at the end of last year. There was a lot of sales front-loaded ahead of that. Orders into the cathode manufacturers are certainly weaker at the current time. We think this is a bit of a first quarter phenomenon as we go through this soft patch. The question for lithium is, where does it settle down? If it settles down at $30,000 to $40,000 a tonne, that's a phenomenal price. on a carbon equivalent basis. So it's a return to normality. I think the long-term growth story in lithium is becoming clearer to people.
Okay. Finally, Colin, we're at the BMO conference. What has been most interesting or exciting to you about the event this year?
Well, to me, it's just the number of people, and it's how happy people are. And first of all, to be having as many meetings and back-to-back meetings. I mean, you see people looking drained because they've been running around and one-on-ones all day. But and it's just the enthusiasm for the sector coming back again. People looking at growth in the sector, which, I mean, you could argue for years it's been this little siloed industry. It is now forming more and more like an integral part of the value chain once more.
I've heard that there's something like 8,000 meetings planned or something like
8,000 one-on-one meetings, and that is individual meetings. We could have 10 investors with one company in those meetings. So if you want to think about it that way, you might have 12,000,
Excellent. Well, thank you very much, Colin Hamilton, for joining us today.
Thank you, Paul.
And this is Paul Harris for Kitco. Stay tuned for more from BMO.
Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.